Here's a question most business owners have not honestly answered. If a sophisticated buyer walked through your door tomorrow and asked to buy your company, could you give them what they need to assess it? Not 6 months from now, not after you clean something up, but now, today. For most business owners, the honest answer is not quite. This is not a failure, this is the starting point. If this is your first episode, welcome. Each one stands alone, but they also build on one another, so I encourage you to watch from the beginning. Today, we're looking at the pre-sale readiness check. 6 indicators that I'm going to walk through with you. The first is owner dependence. This is a tough one. If your business cannot function without you for a couple of months, if the key relationships are yours alone, if the key decisions are made by you, if customers call your cell phone directly, then what you have is not a business as a buyer would typically define it. You have a job. Many buyers don't want to buy jobs. They buy systems. They buy processes. They buy businesses that can operate and grow after the current owner walks out the door. The value of the business to the buyer is the value of its future cash flows. And if those cash flows depend entirely on you, the price is going to be at risk. Now, this doesn't mean you have to solve this overnight, but you need to know it going in, because a buyer will either offer a lower multiple, accounting for the owner-dependent risk, structure an earnout that keeps you involved and working for years, or require a lengthy transition period as a condition of the deal. The fix, of course, is documented systems, trained staff, key employee or employees who are contractually committed to the business, not just loyal to you personally. We'll cover those agreements in episode 8 on due diligence. The second indicator is clean financials. Buyers and their accountants will ask for 2 or 3 years of financial statements right off the bat. They'll scrutinize every line. The issue is this: most small business owners run certain personal expenses through their company, vehicles, cell phones, some travel. This is perfectly legal, and it's common in Canada. But during the sales process, it complicates the valuation picture. What buyers will do is normalize what's sometimes called the seller's discretionary earnings, or SDE, or in bigger companies, and so sometimes brought back into small businesses, EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization. And what they'll do is they'll take your fundamental earnings and then they'll add back in the parts that are really personal benefits and one-time items. The problem is, if they're doing this analysis instead of you, you're on the back foot. You're defending the numbers they've brought to you. So the better path is to work with your accountant now and calculate your normalized SDE yourself. Document the add backs. Understand what your business actually earns at an arm's length basis. Walk into the buyer conversation then with your own analysis in hand. I want to be very clear. This is not about hiding anything. This is about accurately valuing your financial position. Indicator 3 is customer concentration. This is very common in small businesses. If one customer represents, say, 20-25% of the business, that becomes a risk for a sophisticated buyer. They'll flag it, because that relationship doesn't necessarily transfer cleanly over to the new owner. They're not buying the business they thought they were buying. And so the response from buyers is typically one of a few things: a significant price discount to deal with that risk, building in a caveat so that the value only comes if that client stays with them, or making you stay on for the long term and maintain that relationship. Or they may just pass entirely. Now, I know this isn't a quick fix, but what you need to start thinking about now is diversifying your client base. Indicator 4, recurring versus projected revenue. This is a big one depending on the kind of service contracts you have. If you look at the math, buyers pay for certainty. Recurring revenue is more certain than random projects. A buyer modeling future cash flows will assign a higher multiple to a business where a significant portion of the revenue comes from repeating valued contracts. If your business is entirely or mostly project-based, then maybe it's time to think about whether there's a way you can integrate this. Is there a part of your business where a service contract or maintenance model could convert some of these projects into recurring revenue? Even a partial conversion changes the story for later. Indicator 5, transferable contracts. This is where I'm going to put my lawyer hat on a little more specifically. Your key customer and supplier contracts, if they're in writing, likely have assignment clauses. An assignment clause determines whether a contract can be transferred simply by you or whether it requires the other party's consent. This matters depending on how the deal is structured as a share sale or an asset sale. And I'll get into that more in episode 7. But the short version is that on a share sale, the corporation continues to be the contracting party, so many contracts will survive automatically. On an asset sale, however, contracts generally cannot be transferred without counterparty consent, meaning the buyer may need to renegotiate your most important customer relationships. Some contracts also contain change of control provisions. These are clauses that give a counterparty right even if it is a share sale. These are common, for example, in commercial leases, government contracts, and franchise agreements. So you need to have a lawyer review your key contracts before you go to market. Knowing what you're working with is not a problem. Not knowing is the problem. Number 6, licenses, permits, and regulatory approvals. Just in brief, if your business holds licenses or permits that are material to the operation, make sure these are in line. Are they held by you personally? Are they held by the corporation? Are they tied into professional services like the College of Dentists and things like that? The legal foundation now. 3 things your lawyer should typically review. As you're getting ready, let me give you 3 items to address even now. First, your corporate records. Let's make sure those are in order. The Business Corporations Act requires you to maintain a share register, minutes of directors and shareholders meetings, and a register of directors and officers. Missing or deficient minute books are a huge red flag to buyers. Buyers' lawyers will look for them immediately, so we'll go through this in a little more in-depth next episode. Second, your shareholders' agreements, if you have them. If there are multiple shareholders, the shareholders' agreement likely governs how and to whom shares can be sold. Are there rights of first refusal, drag-along rights, tag-along rates, consent requirements? These will determine the mechanics we're going to use in any sale. Third, key employee documentation. If your top people are not under written employment contracts with appropriate non-solicitation provisions, a buyer's biggest concern is that those employees will leave when you do. A well-drafted employment agreement is not just a retention tool for running your business, it's a value-protecting asset. Now, most businesses have gaps in one or more of these areas. You're not unique if you do. It's completely normal. Building a business and preparing a business for sale are really 2 separate things. The point of this episode is simply this: go into a sale process knowing where you stand, not discovering it when a buyer's due diligence team flags it. Coming up in the next episode, we're going to cover the single most important structural setup that you can take before approaching the market and give a little hint towards a tax provision that can shelter over $1 million in capital gains for qualifying sellers. You won't want to skip this one. In the meantime, if you want to talk through what it means for your business specifically, go on my website, chadgrahamlaw.com, and book a consultation. I'm Chad Graham. See you in episode 3. I'm Chad Graham. I am a corporate commercial lawyer, and I practice out of South Edmonton and Beaumont. My firm, Chad Graham Law, is a boutique firm that focuses on really three things: estate planning, corporate reorganizations, and business transfers. If you're an Alberta business owner who's thinking about selling, whether that's in 6 months or in 6 years, this series is for you. Over 10 episodes, I'm going to walk through the entire process of selling a business in Alberta. From the corporate cleanup you need to do before you ever enter the market, all the way through closing day. It'll be in plain English, using Alberta law, and a framework I call getting to yes. That last part matters. There are two kinds of advisors in these transactions. The first kind will find 20 reasons why something might go wrong and leave you with uncertainty about whether you should move ahead with the deal. The second will identify the same risks, but then help you find what to do about them, how to structure them, and how to keep the deal moving. I'm a fan of the second kind, and this series is built on this philosophy. So let's talk about why this series exists and why it's important right now. Canada is in the middle of one of the largest transfers of business wealth in history. An entire generation of business owners who built their companies through the 80s and 90s and aughts is reaching the point where they want out. They want to retire, to travel, to hand the keys to someone else. The Canadian Federation of Independent Business has documented this pattern extensively. They call it the greatest succession challenge in Canadian history. Hundreds of thousands of Canadian small businesses need to change hands in the coming decade. A very large number of those businesses are right here in Alberta. Trades companies, oil field services, health practices, retail operations, professional services. And most of those owners have never sold a business before. That's not a criticism, of course. Why would they have? Most of them spent decades building this thing. Selling, however, is a completely different skill. It requires legal preparation, the right corporate structure, a clear understanding of process, and advisors who know what they're doing. The owners who get hurt are the ones that show up to this process unprepared. That's an unfortunate truth. Most of them are unprepared. In my practice, I see business sales and deals fail or underperform for three main reasons. I want to name them here, and then we'll spend the rest of the series solving for each one. Reason one, the corporate structure is wrong. The company doesn't qualify for a tax shelter that the seller is legally entitled to on qualifying share sale, a provision worth potentially hundreds of thousands of dollars. Or the corporate records are a mess and nobody can really understand who owns what, when shares were issued, or whether the minute book reflects reality. Buyers will find this in their due diligence, and they either price it, meaning they discount their offer, or they walk away entirely. Reason two, the process is reactive instead of proactive. The seller gets excited when a buyer expresses interest and rushes into a letter of intent without legal advice, without accounting advice. They share sensitive financial information without a proper confidentiality agreement. They agree to a sales structure that cost them 6 figures in tax because the buyer asked for it and nobody explained the alternatives. Reason three, leaning on the wrong advisors. This is the one I care most about because it's one that I'm in a position to do something about sometimes. Whether it's brokers, the intermediaries, the CPAs, the lawyers, those who live by risk treat every issue as a reason to say no. But that's not really serving their client. They're serving an instinct to be cautious. And in many ways, there is a time in the process to be cautious, but it's not right at the beginning. The right lawyer will identify risks, but they'll explain them clearly and then find a path through them, if it's a path you want to take. Let me give you a quick roadmap of where we'll be going from here. In episode 2, we're going to make a little check and see if you are pre-sale ready. Is your business good to go? Would a buyer pay a fair price at the market value for your business today? Most owners don't know the answer. We'll work through that together. Then in the third episode, we'll look at the most important legal piece of this series. We'll look at the corporate cleanup you need to do before you approach the market, and we'll introduce federal tax provision called the lifetime capital gains exemption, which can shelter over $1 million in capital gains. from taxes on a qualifying share sale. You need to understand it, and you need to be able to work through it carefully with your accountant. Episode 4 will cover valuation basics, how buyers typically calculate what your business is worth, and how to set realistic expectations before you ever walk into a negotiation. In episode 5, we'll cover the go-to market process, business brokers, M&A advisors, confidentiality agreements, and how to protect your information as you find the right buyer. Episode 6 is about the letter of intent. This is the document that most sellers sign without reading it carefully. It looks non-binding, and some parts of it are not, but others are. Getting this right can save you a lot of money and heartache. Episode 7 may be the most consequential episode. We'll look at some structure questions here. Do you sell by an asset sale or a share sale? Buyers and sellers can have directly opposing interests on this question at times. I'll explain why, and how to find a structure that works for both sides. Episode 8 is all about due diligence, what a sophisticated buyer's team will examine, and how to prepare so the process doesn't derail your deal. Episode 9 will take you from the signed LOI all the way through to closing day. The purchase agreement, the conditions, the closing mechanics, and what actually happens when the deal gets done. Finally, in episode 10, we'll have a little conversation about what it means to have the right lawyer on your file, what getting to yes actually looks like in practice. So if you're a business owner and you've been thinking about an exit, whether that's in the near term or maybe a few years out from now, I want you to know something. The time to start preparing is now, not when you have a buyer at the table. The legal and structural preparations that make a sale successful take time, months, sometimes even years. The owners who exit well are the ones who started this process early. So subscribe so you don't miss any episode in this series. And if you want to talk about your specific situation, visit chadgrahamlaw.com and book a complimentary consultation.